All right, welcome to Talk Tickers. Today we're diving into Bridgewater bank shares. Now, a lot of regional banks are in some pretty choppy waters right now, but Bridgewater, they just hit the accelerator, pulling a key profit target way forward. So let's break down exactly how they're pulling it off.
And you can just feel the confidence coming from the top. The CEO, Jerry Bach, he didn't just say it was a good quarter. He basically framed it as a launch pad for the next year. That's the kind of tone that gets investors to sit up and listen.
So how did the market react? Well, we saw a nice little pop in the pre-market. But look, this wasn't some huge, shocking surprise. It was more like a confident nod from Wall Street confirming that, yep, Bridgewater is doing exactly what they said they would, and a lot of folks were already expecting great things.
Okay, so what are the numbers that got everyone talking? Let's peel back the curtain and look at the headline figures that show just how they beat the street.
And it was a really clean beat, both on earnings and on revenue. Adjusted earnings per share came in at 44 cents, a couple pennies ahead of what analysts were expecting. Revenue also came in a little hot. Just solid, straightforward, no funny business. That's exactly what you want to see.
But here's the real standout metric for me. Net interest margin, or NIM. It expanded to 2.75%. Now, in this environment, with so many other banks seeing their margins get squeezed, this is a huge win. It tells you they're managing their costs really well while making more money on their loans.
And what's fueling that awesome margin? Healthy loan growth. We're talking an almost 9% annualized pace. That shows there's real demand for what they're offering, and they're not having any trouble putting their capital to work. And to round out the highlight reel, tangible book value per share is up over 15% from last year. Now, this is a big one for long-term investors. It's a fundamental measure of the bank's actual worth, and seeing it grow like this means they are consistently building real value for shareholders.
So yeah, the headline numbers look great, but honestly, they're not even the most bullish part of this story. The biggest signal from this call actually came from what management said about the future. They're seeing some serious momentum building up. Get this. Management used to say they'd hit a 3% net interest margin target sometime in early 2027. Well, on this call, they just took that timeline and completely shredded it. Now they expect to hit that crucial 3% mark by the end of 2026. That is a massive vote of confidence in where their business is headed.
And here's the kicker, the absolute best part. They're not counting on any help from the Federal Reserve to get there. They made it super clear that their path to 3% is all about their own business, repricing their own loans. It means they control their own destiny here, which totally de-risks that forecast.
So if the margin story is all about profitability, you got to ask, right? Where's the actual durable growth coming from? Well, the earnings call gave us a very clear answer on that.
It turns out their growth engine is this really smart, specialized niche they've carved out in affordable housing. I mean, look at that. Balances grew 29% for the full year. This is so strategic because it's a space that isn't as crowded, there's always strong demand, and it basically gives them a competitive moat. Genius.
Okay, so with all this momentum behind them, what does the road ahead look like? Let's pivot to the official outlook for 2026 and see what the game plan is. Management really laid out a simple 3-point playbook for everyone. First, keep that loan growth humming along in the high single digits. Second, hit that magic 3% net interest margin by the end of the year. And third, keep a tight lid on expenses. You gotta love it. It's clear, it's disciplined, and it feels completely achievable.
So when you put this all together, where do we land? Here at Talk Tickers, we're officially rating Bridgewater bank shares an outperform. I mean, you've got flawless execution, accelerating profits, and this killer growth niche. It just makes them a total standout compared to their peers.
So our analysis points to a clear winner. The big question is, how could you actually act on this info? Well, that brings us to my favorite part, the trade idea.
Let's be real, the whole regional banking sector is kind of messy right now. It's super sensitive to headlines and what the broader economy is doing. So the million-dollar question is, how do you bet on a winner like this without getting dragged down by the rest of the sector? Well, here's one way. A classic pair trade. You go long on Bridgewater, while at the same time you short the KRE, which is the big ETF that tracks all the other regional banks. See, the beauty of this is you're not just betting that banks will go up. No, you're making a very specific bet that Bridgewater's superior execution will make it outperform all its peers, no matter which way the market goes. It's a trade designed to isolate their specific strength.
And of course, we always have to say it, this is for informational purposes only. This is not financial advice.